What's going on, YouTube fam? This is the Wealth Investing Network. We do this for the win. You're getting a sneak peek into my stock portfolio and a sneak peek into my research on stocks. Today, we're talking about good old Chargepoint and another newcomer to the stock market, Volta Charging. And why don't you just go ahead and give me an early like on this video and subscribe if you're new to help the channel grow. These things help me help improve the content for you, and that's what I call a win-win, and we like that here at the Wealth Investing Network. So as we know, both Chargepoint and Volta are brought to the stock market within the last year or so via SPACs, or special purpose acquisition companies, and they're known to be more volatile. As SPACs, they had different ticker symbols and they traded at around $10 until they announced that they were merging with Chargepoint and with Volta respectively, and there's often a few hype cycles based on news coverage and what's going on. And as we've seen with a lot of companies, including Chargepoint, once the merger finalizes, things can kind of level out. But if you look at Volta right now, they might need a warm blanket. Right about now, they're being frozen out and they're not even in the swing of doing earnings reports yet. Chargepoint, on the other hand, has had a few now, and we saw back in the summer that they beat revenue expectations and offered strong guidance. But keep an eye on this, because strong revenue for the present and future is the only thing that matters for this company right now. Why? Because they're deeply unprofitable and they're burning through cash. But guess what? That's what it takes to have the most chargers out there, and that's the investment in their business that gives them the greatest market share. That's an advantage when President Biden is talking about a multi-billion-dollar plan to create a network of over 500,000 charging stations. To put that planned 500,000 charging stations in context, Chargepoint currently has over 150,000 ports globally. They have been doing this a long time and they've been able to scale. They are one of the largest networks, and in terms of level 2 charging in the US, they are the dominant player in the space. They're miles ahead of their closest competitor in terms of pure play charging. And so only Chargepoint and maybe Tesla might have the software capacity and scaling to help build the network that Biden is talking about. But Tesla doesn't get invited to the meeting, so that's a whole nother story. But sticking to Chargepoint, like I've said before, I like their strategy of offering all 3 levels of charging: home charging, public charging, and the key is software. Because EV charging is not going to be like the gas station model. You will definitely be using a screen. You probably won't have to pull out your card. It'll all be in an app, and customers will only want to use one app for their charging needs. And since Chargepoint has the market share, they're setting themselves up to be like the Apple App Store of charging. If you're looking for a place to charge in public, Chargepoint's app is probably going to be your best bet pretty much wherever you are. And even if it's not one of their chargers, it's a partner in their Chargepoint network like Electrify America, EVBox, EVGO. And so keep in mind that the software is key, not the actual ports. But now I want to contrast Chargepoint's model with Volta's model. Volta wants to be at the intersection of EV fueling, data, and media or advertising. They want to develop, own, and operate public chargers and create a network with software. But their chargers have these giant screens, and companies can pay Volta for ad space. This is unlike Chargepoint, who's more about selling their hardware, whether it's commercial or residential, and really driving things with the software. Volta is only doing public charging. DC fast charging and level 2 charging are their only offerings. And while those are more expensive, their advertising model can subsidize the price to the consumer in some cases. The actual charging can be free. I don't want to repeat myself too much from other videos, but the short version, or TLDR, is that faster charging means higher cost for the company building the station, which hurts margins, and it can sometimes cost the consumer just as much as gas. So it's exponentially cheaper to just charge slowly at home, and it's just more efficient. Unless, of course, you're driving hundreds of miles daily. If you're driving hundreds of miles daily, you pretty much need DC fast charging. But honestly, that's not most people. But this changes, of course, if Volta can offer you a certain number of minutes of free fast charging. In this example from their investor deck, it might be 15 minutes of free charging and then a fixed price per kilowatt hour after that. And that's similar to a media or advertising model, because you get something for quote unquote free after having a giant ad in your face. Think Facebook or Instagram. And then, of course, there's in the background that data piece, and that might not be active now for Volta, but the writing's on the wall. If Volta can succeed here, then other companies will probably copy. I mean, we've seen brand deals with Chargepoint and also BEEM Global and other companies, but it's not to the level of Volta where it's key to their business model. And also, Volta has first mover's advantage in going all out on this. They'll have chargers in prime areas like shopping malls and stadiums, commercial areas that can attract a lot of eyeballs, and they'll have relationships with the advertisers. They'll have the data, they'll have the customer base. And so that's the vision for the future with this company. One of the problems that I see here is that they only have a couple thousand charging stations out there. Plenty of room for growth, I guess, but that leads to another issue. In both Chargepoint and Volta SPAC merger, they were set to get around $600 million. In Volta's case, it was around $662 million. And this funding would help them be debt-free, have a big bag of cash to invest in their business, and scale until they're actually profitable on their own. Chargepoint got the whole bag, but Volta, on the other hand, has fumbled the bag. The stock was trading below the $10 SPAC price heading into the merger approval, so they weren't able to redeem as many shares. What I'm seeing is that this means they only got around $420 million out of a possible $662 million. And after they pay off all the transaction fees and liabilities on their balance sheet, this might look more like half of the money that investors assumed, and this could impede how quickly they can grow. You can see why the stock price went down, but you can make the case that still having hundreds of millions of dollars to work with is fantastic. But for a speculative stock that pretty much only has projections to stand on, having half the cash changes the assumptions and destroys investor confidence, even if the company is saying that they're still on a path to hit their original financial targets. So the company might be fine. There's pretty lofty projections. They still might be able to hit those, but that's completely separate from the stock, because right now it's about meeting or beating expectations, but we're still waiting on some earnings reports. And so I haven't dipped into this one. I am long Chargepoint, which we've talked about before, but I do have some concerns with what Chargepoint's done recently. Even though Chargepoint got their full $600 million they were able to add to their balance sheet for their IPO, it's troubling to me that so soon they spent almost half of their cash immediately through acquisition. They acquired an Australian EV software company that has made huge waves in Europe. Look, I'm sure that acquiring this company makes a lot of sense in terms of their big software push, because it essentially doubles their network, including roaming charging points. But I think that one of the assumptions that many investors had was that Chargepoint's $600 million would go towards developing charging stations and software, not necessarily scooping up a competitor. And for them to do this so soon after going public, that raises questions to me. Now look, I don't know why the stock was falling, had a slight rebound recently, but hey, I'm not a financial advisor, and this is not financial advice. Create your own framework for how you pick stocks. And hey, because I'm such a nice guy, I'll show you my framework. So, okay, we have the two companies. We have their stock prices, but more importantly, their market caps, because their market capitalization is how much the stock market is valuing these companies. The stock price is just a function of the shares outstanding and the market cap. Neither of these companies have PE ratios, because this is a measure of profitability. And like we said, these companies are bringing in revenue, but not profits. So let's take a look at that. Clearly from the revenue, you can see how their Chargepoint is a much bigger company. And when we look at their price to sales ratios, they're almost even. Now, what this means is the multiple that you're paying for the stock. You want your price to sales ratio to be as close to 1 as possible, because it's the market cap divided by the total revenue. You're still paying a double-digit multiple for this multi-billion-dollar stock. And it's about the same with Volta. A reason to pay a multiple for a stock is revenue growth. And both of these companies are growing at very impressive rates. They're on pace to double every year or couple of years. And that's what you want to see. But what I will say is these price to sales ratios are very high, especially because these companies have a lot less cash than we previously thought. But at the end of the day, I like Chargepoint because I think market share is so important when it comes to this space. I think a lot of articles that I've read kind of focus on when they expect to break even and start being profitable in 2023 or 2024. But to me, what really matters is the market share. But I want to hear from you. What do you think? Do you think that market share is the most important thing? Or do you think that Volta's model in terms of having advertising puts them in a better position as a company? And I'm going to keep this one on my watch list, but with so much uncertainty, I just don't know. What do you think? Be sure to check out my channel page. The link's in the description for other videos. I got to go run 5 miles. Thank you so much for watching. See you in the next video.